answered the questions that I had posted in the forum. So it was good to see that, and everyone replied very well. So it's good. You are people are showing interest, and the more participation you show, I mean, I can see that there's interest, and that's that's a that's a part to encourage learning. So in this class, we are going to talk about financial market. So do you know what a financial market is? Deepak, Manas, anyone?
No, sir.
Yeah, financial market is somewhere we can buy and sell financial securities like stocks, bonds, or commodities. So that's a financial market. Like the stock market is an example of financial market, or the banking sector, or like chit funds. That is also an example of financial market. And commodities like gold or agricultural products which are sold, that is also a type of financial market. So like money uh, depreciates in value over time. Like 100 rupees today will not be giving the same value after a year or after 2 years. So money usually tends to depreciate over time. That's why we invest. To there are two reasons for investment: time value for money, in order to make more money over time with the help of investment, so that even if money depreciates, we get more value than the depreciation. And second thing is to save for the future. So that's why we invest, and this process called investment. So because future is uncertain, like might be earning good amount today, but your income might go down in the future. So in order to mitigate that risk, we invest that money. And there's also inflation, as I told, and inflation usually depreciates the value of money. So um, I'd like to ask a question. Can you imagine a phenomenon which is opposite of inflation? Anyone? Amil, Manas?
Hello, sir.
Yeah, inflation where money loses its value over time. Like 1,000 rupees today will be worth, let us say, 980 rupees after a year. So that is inflation. And the opposite phenomenon will be deflation. So in a country like India, inflation rates are high, and in developed economies like US or Japan, not Japan, let's not talk about Japan, or let's talk about Europe. So inflation rates are a little bit less, but there's also a phenomenon called deflation, which is opposite of inflation. So here what happens, a rupee today will be worth more than a rupee after some time. So that is deflation. So deflation, uh, in deflation, since money gains value over time, um, it may not be a very good thing for economy. It might sound that it is very good, but it is not good actually. Because if someone wants to invest in real estate, they'll not do it immediately. Real estate or any investment, because they'll get it for a cheaper value at a later date. So they'd like to defer their decision to invest. And since people do not invest, the economy slows down. So, and that has been a very big challenge for the Japanese economy for more than 2 decades, almost 3 decades. So people do not like to spend money, and since people do not spend money, investors are not able to get returns on their investments. So, uh, the economy has gone into kind of recession, and they tried almost everything to overcome this, but that has nothing has helped. So, can you tell me, like, inflation? Do you think inflation is a good thing or a bad thing? Anyone?
Good thing, sir.
Good thing, yeah, good thing, right? But inflation in moderation, like if we have 3-4% or even 7-8%, that is a good thing. But if inflation is very high, then that is also very bad. Like what happened in Zimbabwe. Uh, in uh, in Zimbabwe, a few years back, there was hyperinflation. Like today, something is costing you 100 rupees. Tomorrow, it starts costing 1,000, and day after tomorrow, it starts costing 100,000. So that is called hyperinflation, which is very bad. So like that completely destabilizes the whole economy. So because like if everything becomes so expensive, people will not be able to buy that. They'll not be able to have more income to meet their regular demands, to meet their basic needs. So that's what happened in Zimbabwe. That's a phenomenon of hyperinflation, and hyperinflation is a very extreme thing, extreme situation. I mean, if we talk about like inflation about more than 15%, 20%, that is also bad. So we can say that inflation in moderation is good, and that phenomenon is seen in all developing countries and economies which are uh, growing steadily. So we can see some moderate amount of inflation, moderate or even high. But economies which are very developed, like U.S. economy, or let's talk about Germany, countries like Germany or United Kingdom, France, their inflation rate is much lower. So, and very low inflation rate is also not good because that means economy is not growing at a fast pace. So that is also a bad thing for the growth. So inflation in the bracket of 3 to 4% to 7%, or let us say 10%, can be considered healthy inflation. That is a healthy thing for a growing economy. So so that is the reason we invest in order to meet. And inflation is a phenomenon which is universally seen. It is there in almost every country which is doing well. So inflation rate might be high or it might be low. And one more interesting thing about inflation is that it is also correlated to the interest rate in that country. Like in India, suppose inflation is 4%, and banks are giving interest rate of 6% or 7% on fixed deposits. So that is not the case in US. In US, interest rates are very low because here inflation is also very low. So inflation is directly correlated with the uh, interest rates in the country. So the financial market is where people are able to buy and sell financial securities or commodities, as I previously told. So commodities can be like gold or even wheat, rice. These things also can be commodities. Financial securities are like stocks and bonds. Any question? Anyone? Have you people gone through the reading material? Okay, moving on to the next slide. So financial market is of different type, like capital market where people trade stocks and bonds. Then there's commodity market, as I told, and there's money market as well, where the maturity is anywhere uh, between a day to less than a year. So that is money market. Like people lend money from private lenders. That is an example of money market. Does anyone know what a derivative is? So let me give an example. Suppose you are very interested in buying a ticket for IPL match, and there are no tickets left, and you are about to leave. And suppose the ticket costs 20,000 rupees, and you are going to leave because you did not find any tickets. So, but your friend arrives, and he gives you a letter that if you show this letter, you can get the ticket for 20,000. The match is going to happen after 5 days, and so um, so uh, so in the black market, the ticket value will go up. I mean, because in the black market, tickets are sold more expensive. So suppose the ticket value goes to 23,000, and you have the letter. So you have the letter, and you can, if you show the letter, you can still get the ticket for 20,000. So suppose the cost of the suppose the cost of the ticket in the black market has gone to 23,000. You have the letter, then the letter is a derivative in this case. Okay, so so that letter um, will be worth 3,000 in that case. If the cost of the ticket in the black market is gone 23,000, and by showing the letter you are getting the ticket for 20,000, then the letter is a derivative and it's worth 3,000. And suppose it goes to the value of the ticket goes to 25,000 in the black market, and you have the letter, then the value of the derivative, or the letter which is which you have, will be 5,000. Suppose you fall sick, and the match happens and you're not able to watch the match, and or you are not able to sell the letter also. So the value will go zero. So the value of derivative is time bound, and uh, it has to take place within a given time frame, and the underlying is the cricket match. Okay, so the value of the derivative depends on the value of the underlying. So this is an example, and similarly, like people have uh, future options, future forwards and options. So an example of future is like suppose you are a farmer and you are selling cotton, and you're not sure whether what the cost of cotton will be after 6 months. It might go up, it might go down. So you enter into an agreement with someone, and have a condition that you'll be selling. Suppose cotton is costing 2,000 rupees per quintal at this time, and after 6 months you enter into agreement to sell it for 2,500. So its price might go down, or its price might go up as well, but you are entering into a forward contract. So so that way, this is an example of the derivative market, and it's a forward contract. The forward contract is between two people, and uh, there are no middlemen. So same way, there's future contract also, but in future contract, there's a middleman involved, or like some financial institution might be involved, and that is secured. I mean, because you cannot default when there's a middleman involved, like a financial institution, like suppose RBI is regulating that. So the chance of default will be less in case of uh, future, but in case of forward, when there's no middleman involved, so chance of default will be high. Suppose the price of cotton goes up to 3,000, then the person with whom you have entered into agreement to sell it for 2,500 might not pay you that amount. He'll think, why I shall pay that much amount, and why shall I incur loss of 500 rupees per quintal? And if the if the price, um, I, I mean, in that case, the person would like to buy because the price has gone up. But suppose it goes down, suppose it goes to 1,500, then it will be his loss to pay 2,500. So in that case, he might default, and in case the price goes up to 3,000 instead of 2,500, then you might default. So that is an example of derivative market. Then there's the insurance market, like insurance policies that we buy. And insurance is also of two types, like a simple insurance or a unit-linked insurance. With unit-linked insurance, you also make money out of the investment, and it is directly linked to the stock market. That is called a ULIP, or a unit-linked insurance. And insurance can be of different types, like health insurance, life insurance, or car insurance. Then there is forex market, foreign exchange market, where people like you are selling a dollar for some money. I mean, someone is suppose there's a broker who's selling dollars at $60 per rupees, while its actual value is 65, um, and uh, selling at a lower rate, and selling at a higher rate and buying at a lower rate. So, like if he's selling at suppose 67 and buying at maybe 58, so he's making a profit of 9 rupees per dollar in the process of selling it and buying it. So that is an example of foreign exchange market, where people buy and sell currency. So I'd like to ask a question here. What do you think? Can you tell me any one factor on which the rate of the exchange rate of a country's currency depends? Anyone? See, if your economy is very stable, like US, Japan, the exchange rate for that currency will be high. And if economy is growing economy like India, so the value of rupee is less. Like for $1 you get 65 or 66 rupees. So uh, it also depends on the trade deficit of that country. If that country is exporting a lot of things and importing less, so that means that country has a lot of money in reserve. So their currency will be costing more. Like dollar costs a lot more than rupee, and it also depends on one factor, like political stability in that country. So if there's political instability in the country, like what happened in Zimbabwe a few years back, there was hyperinflation, and suppose country like Pakistan, there's always political instability in that country. So their exchange rates are worse than India. But that is just one of the factors that I'm telling. That is not the only factor on which the exchange rate of the currency depends. And it also depends on the interest rate. Like interest rates are higher in India, so the value of rupee is less, and interest rates are very low in US. So its dollars value is high. So you can say that exchange rate might is kind of inversely proportional to the interest rate is inversely proportional to the value of the currency. So that is another phenomena that we observe. Any question? So retail investors has many options. Like you can invest in insurance. I mean, in insurance, in return of the investment, in return of the money that you're investing, you get some sort of security, some sort of guarantee that you'll get back this amount. Like someone has health insurance, and if you paid a premium, so if you face some challenges, you go to doctor or you get hospitalized, then the the company which has sold that insurance pays for that. So that is one example. And like in case of unit link insurance, you also get that is also directly insurance. Like there's a life insurance that is also directly linked to the stock market. So the value of the insurance goes up if the stock market is really doing well. So that is another kind of insurance. Then everyone knows what real estate is. Here the return rates are very high, like 10%. I mean, when the economy is growing, everything is good. I mean, it can also be the return can also be less and can even be negative. Like the value of real estate went less than what it originally was during recession time during 2008 2009. At least that happened in the United States. So I'd like to pause and ask a question. Do you know why the big recession in 2008 2009 happened? What was any reason? What was the reason? Anyone can tell me or anyone can guess? Deepak, Gurpreet, Manas, anyone? See that crisis started because the banks were giving money. I mean, interest rates were very low in US at the time. So people did not have to spend a lot for buying homes. So people started buying homes, and because the interest rate was close to zero at that time, so a lot of people bought home. People with good credit here in the US, everyone checks the credit history. I think that has started happening in India also. So everyone checks the credit history, and people who have good credit history, they get the loans easily. But what happened in 2001, 2002? Banks started giving loans to also those people who had bad credit history. Bad credit history means you are likely to default. I mean, they check the credit history, they find out whether you have been doing the payments on time or not, and mm, and that will tell whether you are likely to default in future or not. So many people spend more than what they have, and so yes, banks also gave loans to those people who had bad credit history in the United States. So at higher interest rate. So that was called subprime. I mean, those were called subprime lenders. So those people who were likely to default, they got loans at high rates, and they started defaulting. And at the same time, a lot of people defaulted, and the values of real estate collapsed. I mean, it crashed. It didn't become zero, but it became much less than what it originally was. So that prompted more people to default. More people did not pay their loans, and as a result of that, um, a lot of banks who had given loans and they're taken security as home itself as the mortgage. So, I mean, they didn't get money from the from those people, from the buyers, and they could not sell those houses also to make money because the rates had dropped so drastically. So as a result of that, many banks who had lent out, who had given billions of dollars to homeowners or buyers, became bankrupt because they were neither able to get their money back or interest or the original, and they were not even able to sell those houses. So that caused many of the banks to collapse. Many big banks like Lehman Brothers, and since US is the biggest economy in the world, that caused also um, worldwide economic recession. So because US has trades with so many countries in the world, and the impact of that recession was seen all over the world because US is the largest economy in the world. So that triggered problems not just in US, in Europe, Middle East, also in India, worldwide, and its impact was seen for several years. And it took many years for United States to recover from that. Guys, I'm telling very interesting topic and there's no participation, so no one is responding. Are you guys finding this interesting enough? Are you guys still there? Okay. Okay, good. Good. Let me carry on. People also invest in gold. Like gold has given not very high returns, but some it is considered to be very safe investment option because the value of gold rarely crashes drastically. It goes up and down a little bit, but over the years it has generally given a moderate return, so it is considered to be a safe investment. Real estate is also generally considered to be safe, but seeing what happened in the US a few years back, so you cannot say that it is 100% safe. There's risk with real estate investment as well. Post office scheme like MIS, so or Kisan Vikas Patra, those are post office schemes. They also provide good interest rates. That is also considered to be a safe investment option. Then there are FDs with banks, like if you have an FD and bank has guaranteed you some rate of return on that, I mean, bank is bound to pay that, and the bank, unless and until goes bankrupt, banks honor their commitment, like State Bank of India, ICICI Bank. They are very less likely to default. Then there's mutual fund, like mutual fund has a big portfolio. I mean, the mutual fund managers take a lot of stocks and try to minimize the risk and maximize the returns on those portfolios. So then there's debt like debt we take from the bank, and equity is like a share in a company. So those are options for retail investors. Any question? Anyone? Okay, let me move on to the next slide. So, like a company wants to make some money, raise some money from market, they can come up with an IPO, and like IPO is the initial public offering. They are selling a part of the company, or giving a giving a promise to those people, to retail investors, that they'll be paying this much amount, a given amount for a share. So that is the initial public offering. The cost of the share, rate of the share can go up and down depending on the performance of the company, and also depending on the current conditions in that country. Like in India, the economy is growing, so we can see that the stock market has been generally doing very well. And those are like retail investors, and there are also institutional investors. So institutional investors buy equity shares from companies um, in the primary stock market, and retail investors buy from the secondary market. Like if me and you people, we want to buy from some company, then we cannot buy directly. Like we buy from the secondary market. Primary market, where there are big investors, and they can get shares directly. So even before the IPO. So that is the primary market. Moving on to the next slide. So what is debt? Anyone? Debt is like when you are lending money to someone with predetermined terms, like you have to pay not just the principal but also interest on that. That is debt. So debt you can take from banks, or and also from you can take debts personally from other people. So there are two types of debts. Like if government wants to raise money, they take money from people and they issue bonds, government or public sector organization. And if company wants to take debt, then they raise debentures and issue it to people, private companies. Those are called debentures. So mutual fund is a collective investment vehicle or a portfolio where the mutual fund managers try to minimize the risk. And there's a large pool of resources. There are so many stocks in the portfolio, and those people are very professional. Mutual funds normally provide good rate of return, but there are no guarantees. No guarantees because we have seen that during recession, during bad financial times, the value of mutual fund also goes down. You cannot consider it to 100% safe. And diversified investment, because there are so many stocks from different companies. So this portfolio is very diverse, and the basic incentive is to minimize the risk and maximize the gains. We all know what FDs are, fixed deposits. Here, risk is lower, and you get guaranteed the rate of return. Like you lock in a fixed deposit 5 years, you can be sure that you're going to get this much amount, and that is like 6 or 7% right now. So that is slightly higher than the inflation, but overall you do not lose money over time. But it's not a very good investment option also, because if you are willing to take risk, you can invest in real estate or in the stock market and make a lot more money than fixed deposits. But it will give you slightly more returns than the inflation in the country. Then there are post office schemes. Those are also considered to be safe, and interest rates are little more than inflation, maybe little less than FD, but little more than inflation. So everyone must have heard of MIS, monthly income scheme, which are run by post offices, or Kisan Vikas Patra. So as I told, that gold is also considered to be very good investment option, because it has been providing a relatively safe return over the last few years. But again, it's not the best investment option if you want to make a lot of money, because there are other options like um, buying good stocks, or say investing in real estate, or even people have a lot of money, they invest in good companies and get a lot better return than what gold can give. So we all talked about real estate. Here, rate of return is more than FD or gold or post office schemes. It is more than that. Maybe it can go even up to 10%. But um, it is also not completely risk-free. And again, this is not the best investment option. People who are willing to take risk, they can invest in startups, or they can invest in the stock market and get better returns. But it is considered to be an attractive option, because in India the real estate rates have been going up constantly. I mean, those have been stagnant in the last few years, but before that it was very good, and it reached the peak, and it has kind of saturated there. So, and in India, a lot of people invested in real estate considering that they'll make a lot of money, but a lot of companies, big companies, lost money. They couldn't recover. So so in a sense, it is also not 100% safe. So we talked about insurance also. I mean, insurance gives you security for potential loss, and it is also kind of insurance like which are unit-linked insurances. Those are linked to the stock market, so they can also provide you both things, security and as well as investment which is linked to the market. So if the market is doing good, you get better returns. So we talked about financial market, and I also gave you the reading material. Not sure how many of you have gone through that. I'll post some more questions on the forum, and apart from that, please do the assignment. I think first assignment is already there, so try to do that. We are also going to have a class tomorrow because we couldn't have a class last Sunday. So this weekend we have 2 classes scheduled. Please come up with any doubts that you have, and we will talk again in tomorrow's class. If you do not have any questions, then I think we'll end the session. And I appreciate everyone participated very well, answered all the questions that I posted. Not everyone, but most of you. So, I mean, you learn something well only when you generate interest. And I believe that posting questions on the forum is one way to generate interest in people. So please answer those questions. Please do the assignment, and we'll talk again in the next class.
Hello, sir.
Yeah.
Sir, this is Manas.
Yeah, Manas.
Sir, first of all, sir, thank you. It's a good session so far, and we are learning so many things in financial market. Sir, I have a question for investment sector, like you talked about at the earlier slide about equity share, this kind of thing. Sir, I heard. Sir, equity share, something like that is mentioned from that side. Yes, sir. This side. Sir, I heard many times that some what called angel investor. You know, I am working with a startup, and I many times in my company the people are talking about angel investor. My company is looking for angel investor. You know, my company is growing up. So how a startup can get the money from seed funding and then angel investor? Can you talk about more this how a company grow up and then become a public sector company? How it's happened? I want to know more about it.
Yeah, like if a company is very small, then it can either borrow money from a bank for investment, or they can approach an angel investor. And angel investors do not put in a lot of money. Like they might be putting in anywhere from 5 lakhs to 50 lakhs, 1 crore, 2 crore, but less than $1 million, less than 5 crores. So angel investors do not invest too much, and in exchange of the investment, they take some equity of the company. Some like they might ask for 10%, 20%, or even 50%. So depending on how well your company is doing and how much its valuation is, how much your revenue is, depending on all that, you can approach an angel investor, and that is the for generating a seed capital for the company. But if your company is big, I mean, if you are making the revenues of more than $1 million, 2 million, or 10 million plus, then there's the option of approaching venture capitalists. And venture capitalists are those people who invest other people's money into startups or small companies. And again, there are also the aim is same, to get some equity. And as your company grows, it generates more valuation. Their share also grows, and at some point, angel investors like to sell their equity and they like to exit the company. And there's also something called private equity. So that is like they like to buy anything from anywhere from 50% to 100% of your company. And those are real big investments like 10 million plus. So that is another thing. And they like if someone has private equity at some point, if your company is doing well, they might think of going public, and they might issue a public offering, but they raise money from people by selling shares of the company. So these are the different stages.
And then, sir, when the company can be named in the stock market, we call listed company. So when a company can be a listed company in the stock market?
Yeah, that's a very good question, and let me do some research on that, and I will definitely answer that question in the next class. That's a real good question. So there are some certain conditions that should be met, and I'd like to read about that, and I'd like to tell you. It's a very good question you asked, and right now I do not have the answer for that, but I will definitely tell you tomorrow. It's good you asked that question, Manas.
Thank you, sir. Sure, sir.
Yeah, not every company can be listed in NSE or BSE. They have to meet certain criteria, and not every company can go public. They have to have certain amount of revenue. So certain criteria has to be met, and I'll answer that question in tomorrow's class. It's a good question. Anyone, any other question? Because such question make the session more interesting, and the more interest you show, the more you learn. Anyways, if you don't have any questions, not a problem, and we'll discuss more tomorrow. So I'll end the session today, and please also continue to read from outside, like particularly the case studies. We talked about recession, we talked about deflation, those scenarios. Try to read about those things, and even if you do not find time, I know all of you are working, so I'll try to bring some case studies, and we'll discuss in tomorrow's class. So guys, thank you very much, and we'll talk tomorrow. Bye.